All right, let's get right into it. Today we're going to decode the secret language of the financial markets. We're talking about candlestick patterns, which are really just a powerful way for you to see market psychology in action, spot opportunities, and most importantly, manage your risk.
I mean, think about it. What if you could look at a chart and instead of just seeing a bunch of random squiggly lines, you could actually read a story? A story about greed, fear, indecision, and conviction. Well, that's exactly what learning to read candlesticks allows you to do.
And you know, this whole idea? It's not new at all. It actually goes way back to Japanese rice traders in the 1700s. They figured out that each candle wasn't just a number, but a visual record of a battle, a fight between the buyers and the sellers. It tells you, in a single glance, who won that particular round.
So if we're going to read this story, we've got to start with the alphabet, right? Let's break down what a single candlestick is actually made of.
Every single candle is built from just 4 key pieces of data: where the price opened, where it closed, the highest point it reached, and the lowest point it reached. Now the thick part, that's the real body, and it connects the open and the close. And those thin little lines poking out, those are the wicks, or shadows, and they show you the full dramatic range of the price during that period.
Look, here's the simplest way to think about it. The body tells you who won the battle. If it's green, the buyers won and pushed the price up. If it's red, sellers took control. But the wicks, the wicks tell the story of the fight itself. They show you the exact points where one side tried to push, and the other side said no way and pushed right back. And trust me, size matters here a lot. A big, long green body, that's pure confidence from the buyers. But a teeny tiny body with long wicks sticking out of both ends, that's a brutal tug-of-war with no clear winner. That's total indecision. The wicks show us exactly where the market slammed on the brakes.
Okay, so we've got the alphabet down. Now we can start forming our first words. And these are some of the most basic, but also most powerful candlestick patterns you are ever going to see.
First up, let's talk about the Doji. This is basically the market just shrugging its shoulders. The price opens and closes at almost the exact same spot, meaning neither the buyers nor the sellers could get an edge. But here's the really important part. A Doji only matters if it shows up after a big move, either up or down. If the market is just chopping sideways, a Doji is meaningless noise.
Next, you've got the hammer. This thing is a classic bullish reversal signal. Just picture it. The sellers push the price way, way down. But then, out of nowhere, the buyers storm in with incredible force and drive the price all the way back up. It's like they're literally hammering out a bottom in the market. But, and you've got to remember this part, you always want to wait for the next candle to move higher to confirm that the buyers are really back in charge.
And this right here, this is the perfect example of why context is everything. You take that exact same hammer shape, but you put it at the top of a long uptrend. Well, now it's called a hanging man, and it's a bearish signal. It's a warning sign. The shape is identical, but its location on the chart completely flips its meaning on its head.
Which brings us to what is, without a doubt, the single most important concept in this entire explainer. We have our letters, we have our words, but now we need the grammar. We need the rules that make sense of it all.
You've probably heard that old question, right? Well, think about it in trading terms. A candlestick pattern that forms without a clear trend, without high volume, without anyone really paying attention, it's just noise. It's that tree falling in an empty forest. It doesn't make a sound because there's no context to give it any meaning. So it all comes back to this one golden rule. Context is king. For a signal to be worth anything, it needs 2 things. First, the filter. It has to show up in a market that's clearly trending one way or the other. And second, the catalyst. Something like a huge spike in volume or some big news that gets everybody's attention. So the formula is simple. A clear trend plus big volume plus a recognizable pattern, now that equals a valid signal.
So, we've got our letters, our words, and our grammar. So what's next? It's time to actually write our first complete sentence, to build a full trade idea from start to finish.
Okay, so how do you actually pull the trigger on a trade? You need a clear rule, something mechanical that takes the emotion out of it. One of the simplest is called candle over candle. You spot your pattern, you've confirmed the context is right, and your entry signal is simply when the price breaks above the high of that pattern candle. And your exit if you're wrong. Your stop loss, it's just a break below its low. No guesswork, just rules.
Let's take a look at the bull flag. This is a textbook setup. First, you get a huge, powerful move up. That's the pull. Then you get a period of quiet, sideways action as the market just kind of catches its breath. That's the flag. And you're just sitting there waiting patiently for the breakout.
Your trigger is that candle over candle move above the flag, signaling the next big leg up is starting.
But listen, finding a great entry, that's maybe half the game, if that. The real pros, the people who do this for a living, are absolutely obsessed with the other half, having a rock-solid plan for what happens if they're wrong.
And that obsession brings us to one simple but incredibly powerful ratio, 2 to 1. This little number is the absolute cornerstone of professional risk management.
And this is where the math just works in your favor. It's kind of magical, really. If you set up every trade so you're always aiming to make at least double what you stand to lose, say you risk $100 for a shot at making 200, you only have to be right 1 out of every 3 times just to break even. This discipline completely flips the long-term odds in your favor. It's just pure, simple math.
So there you have it. We've covered the whole language, from the individual letters to full sentences. But how do you actually get fluent? How do you get to the point where you can have a real conversation with the market? Well, like any new language, it all comes down to practice. Here's your path forward. It's a simple 3-step process. First, you have to visualize. That means looking at hundreds, even thousands of charts to train your eyes to see these patterns instantly. Second, you simulate. You practice in a paper trading account with 0 risk until it becomes second nature. And third, you review. You keep a journal and analyze every single trade, win or lose, so you're constantly learning. So let's wrap this all up. Understand the anatomy. Wicks tell you about rejection. Bodies tell you about conviction. Recognize the patterns, but only when you apply the golden rule, that context is king. Execute your trades with simple, clear triggers, manage your risk like a pro, and just repeat that process over and over. So the next time you look at a chart, don't just see prices, look for the story. The only question is, are you ready to start reading it?